I get a lot of YouTube, TikTok videos sent to me from clients basically claiming expense this from your real estate so that you can get a deduction. Maximize your deductions with your foreign real estate. Some people invest in foreign real estate in particular with the expectation on the front end that they're going to be able to deduct all these costs against their regular income. And then they come to me and I have to break their hearts and break the news that it's not that simple. And a lot of times they don't get those deductions. In my experience, the rules are so specific that you don't accidentally fall into the ability to take a deduction on your rental real estate expenses. This is an area of the tax law that is very manipulated, obviously. And whenever you get into these areas of the tax law, the IRS has put in roadblocks in different places to make sure it's not something people can just take advantage of. That's what we're going to talk about in this video today. What are the specific roadblocks? How do we maneuver around them? And how do we maximize your rental costs so that you're getting a benefit out of them, or at least not expecting to get something that you're not going to in the future? The hardest part about these rental real estate rules is that there's different terminology for different rules, and the different rules start to overlap in different ways. So we have to break out how one specific definition applies to one rule and the other, or partially to one and the other. We're going to walk through sort of a flow chart and decision-making process on which rule is going to apply depending on the specific facts, so that we're going down the flowchart path that ends in tax deduction, tax benefit. So we start with our rental house, right? And in this case, we're talking about foreign real estate. So a lot of my clients are people investing outside the US in foreign real estate. Remember, I have a lot of videos on this about setting up foreign companies, making the check the box selection to make sure it's a flow through. In this video, we're going to assume that you took my advice and you're going to have a flow through structure for this scenario, or maybe you just own it directly. So here we have foreign rental property. Remember, especially on the front end, there's a lot of expenses that go into purchasing a home, getting it ready for rent. So on the front end, in that first year, you're almost certainly going to have more losses than income. Generally, how your expenses work is you can deduct anything that's ordinary and necessary to maintain and keep up the rental activity business. And then you have to capitalize improvement costs. So things like the cost of the building itself. If you are putting in a pool or HVAC system, a lot of times those are going to be capitalized and depreciated over time. So if it's a foreign property, you have a 30-year depreciable life, the building's going to be depreciated over 30 years straight line. So the first thing we need to determine when we have this rental property is we have to deal with the personal use rules. So that's our first battle. This is how we determine, is it actually a rental activity from an IRS perspective, or is it more personal use? If your personal use days exceed the greater of 14 days, or 10% of your total rent days during the year. So the days that it's actually rented out, not the days that it's available for rent. The IRS considers it a personal property and not a rental activity, which sets up this limitation on deductions. If you had 100 rental days during the year, that gives us 10 days. You only have 10 days that you can spend in the property before it becomes a personal use property. If it becomes personal use property, now we've limited the deduction. The end result is that you can deduct expenses up to your income, but no more. And the additional expenses are going to roll forward to future years, where those expenses, you have to apply those same personal use rules before you can unlock them. If you had $10,000 of rental income during the year and you had $20,000 of expenses, you can offset the income, so there's no income you have to pick up, but that additional $10,000 of losses gets carried forward under this personal use rule, and then we apply that same personal use test each year till we can unlock it. And that's why, like in later years, one of the strategies I use is, let's say we know that you're going to have a big income event in a future year, maybe a bonus, a payout, or something like that. Maybe we intentionally lock up these losses in the personal use limitation. And then in that year you have that income event, go stay in a rental property or something to get you under this 10% or 14-day rule. And then we can unlock all those prior locked up use losses in the year that you have more income, so you're getting more benefit out of those deductions. That's just one way that we can manipulate these personal use rules. So if you don't pass this test, so let's say your personal use days are less than 14 days or 10% of your total rental days, then it is a rental activity. So once it's a rental activity, we have another set of rules we have to apply. So when you have a business and a rental property is a business, the general rule for a business is that it's an active business if you materially participate in that business. The material participation rules have several points to it, but the main ones that you deal with are 500 hours or 100 hours and more time than anyone else in the business. So if you spend more than 500 hours actively engaged in that business, then you're considered to materially participate, and it's not a passive activity. The bad part of it being a passive activity is that the additional losses, similar to the personal use situation, if you have losses that exceed your income, they get stuck in a passive activity loss basket, and you can't use those against your wage income or other income. They can only be used in the future against other rental income or ultimately when you sell the property. Rental properties are considered per se passive. So even if you pass the material participation test, it's still considered a passive activity, unfortunately. So then we have another set of rules we have to apply, which is real estate professional rules or the 25% rule. So from here, we're going to break this down into another section. The question is, do we materially participate? If the answer is no, you're stuck in the passive activity loss basket every time. If you don't materially participate, it's not active, and you can't take the losses that exceed your income. If you do materially participate, you're unfortunately still in the passive activity loss basket, but there are other rules we can apply to get out of that box of not being able to use the losses. And again, the best case scenario is that you can have losses that exceed your rental income, and we use those excess losses to offset other types of your income. So if you're a wage earner or self-employed and you have an excess loss on your passive activity on your rental property, we want to use that loss against your wage income. So the passive activity loss rules are a big roadblock, basically, in us being able to do that. But there's 3 rules that we work with to try to avoid it from there. We have the short-term rental loophole, we have the $25,000 deduction, and then we have real estate pros. Each of these require material participation, but they have their own subset of rules to allow us to get out of the passive activity. The first one we want to deal with, which I think is the simplest, is the $25,000 rule. You can deduct up to $25,000 of your excess losses against all your other income if you're considered to actively participate in the business. And that's where this terminology can get tricky. Material participation, active participation, they have different meanings. But for the $25,000 rule, as long as you actively participate, which is a very low bar, just meaning that you are making decisions on behalf of the rental property. So basically anyone that owns a property and rents it out is going to be considered to actively participate. So you get up to $25,000. The problem is that there's a very low threshold for where you phase out of this. Single or married filing, separate filing, it's only like $50,000 to $75,000 of income before you're not able to use this exclusion. And if you're filing joint, I think it phases out at $150,000. So for a lot of people, this $25,000 exclusion, you phase out of it, and so you're not there. So if you can't use that one, then your other options are the short-term rental and the real estate professional. Real estate professionals have a layered requirement on top of material participation. So remember, material participation was a 500-hour rule during the year, or 100 hours plus nobody's doing more than you for that rental activity. Real estate professional rules have an additional requirement of 750 hours, so you have to go above that 500 hours, or you're not spending more time on another service-based activity than you are on the rental property. For example, if you're employed, you'd have to prove that you spend more time on the rental property than you do in your employment job, which is almost impossible to meet. So the real estate and professional rule is really only going to apply for retired people, unemployed people. A lot of times, one of the strategies I use is if one spouse is working and the other one is not, The spouse that's not working can be considered the real estate professional because they're not going to get tripped up by this rule. All we'd have to do in that case is hit the 750-hour rule, and now that person can be considered a real estate professional, file a joint return, get those excess deductions on your tax return. That's a very common strategy and one that we use at that point. It's just documenting the 750 hours. And one thing we want to talk about is these actual hours that we're using. So when I say you have to have 500 hours of material participation, 750 hours when coming to the real estate professional rules, that means hours actually working on this rental activity. So that could be managing the property, the administration of the property, so keeping the books, working with tax accountants. The thing that can get really tricky with these rules is when you also have a property manager. So you need to be careful that you don't assign all of the working activity over to a property manager so that you're not doing anything. That's fine, but if you do that, then we're back up here and no material participation, passive activity loss. Which again, it's not the end of the world. It's not like these losses go away completely. They're just being carried forward and they can only be offset against income of that property or of other rental property, really. If you have multiple, you can group things together. It just means they get locked out temporarily. If we can meet this material participation and the real estate professional rules, so 750 hours, we can use those losses against your wage income. And so a lot of times when I work with my clients, especially on the international side, like if you're investing in a foreign rental property, so let's say you invest in a Costa Rican rental property, but you live in Wisconsin, it's pretty unrealistic for you not to have a property manager because you're going to need maintenance people down there. You're going to need cleaning. You're going to need somebody looking after that property for you while you're not there. But what you can do is limit the scope of those activities. You don't want them doing everything. So maybe you still manage the listing within Airbnb. You work with the administration of it. You keep the books. That's something I work with my clients to figure out to make sure that they're still doing enough that we can rack up those 500 hours during the year. And it's easier than you think at the end of the day, because if you haven't done rental properties before, they take a little bit more time than you think when you get into it at the beginning. So it's not hard to hit, but you do have to be intentional about it, particularly if you're using a rental management company. So the last one I want to talk about is the short-term rental loophole. This is the one I probably get the most calls over because it has the biggest benefit. It can be the simplest as far as from an administration perspective, especially for the short-term rental world that we live in now, but there's more maneuvering, I would say, with this short-term rental. So with the short-term rental loophole, as they call it, this means that the average stay for the rental property has to be less than 7 days. So that means you have to be very specific about how you offer the rental property through sites like Airbnb and something like that. Because if they cross that average day threshold, then you're back into these other rules and you're cut out of that short-term rental loophole. But if you can keep it under that 7-day average, then it's not considered a passive activity anymore. And you can offset losses against your regular income from that rental activity. The problem I run into with people that are trying to fit themselves in the short-term rental is one, material participation, because they're probably going to have the rental management company, so we have to be really specific about how we document those 500-hour rules. And then the other one is back to the personal use test. So if you have a short-term rental like that, a lot of my clients are spending a lot of time in those properties. So even if you materially participate, if you cross that 10% or 14-day rule and it becomes a personal property, you get limited under another set of rules. So what we're battling all the time is personal use, passive activity loss rules, and how do we get around both at the same time. So with the short-term rental property, we can do that, but we also have to be tracking personal use days and we have to be tracking material participation. As you can see, to sum this up, the idea is that we first want to make sure it's a rental property so that it is a business and we can capture deductions. And we want to capture as much expenses as we can related to the property, whether that's traveling expenses, things you're purchasing for the home, whatever it may be. We want to capture those expenses because even if we can't deduct them today, we can deduct them later when you sell the property or you earn income. So if you're trapped by the personal activity rule or the passive activity rules, you're still going to get the benefit of those expenses down the road. So we want to document them on the front end. So there's still the idea of making sure we're capturing all the expenses we can. But the next step is, how do we actually deduct those expenses today against your ordinary income, which can be a massive tax benefit? And that's where we fall into these rules: short-term rental, the $25,000 loophole, and the real estate pros. Those are what we're trying to fit into, and it takes some maneuvering to maneuver the material participation or personal use days or the limitations on income. What I do for my clients is I have a tracker that we use to track personal use days, to help people document on the front end what their material participation looks like. So for example, people that are working on the administration of their, like the finances and administration of the rental property, they're going to meet with people, they're doing a lot of the correspondence with clients. We're documenting that on the front end. That way it's very simple for us to respond to an IRS notice or something like that if they were to challenge the position that we're taking on the rental property and taking those deductions. So at the end of the day, when you're dealing with these rental properties and you're wanting to maximize your benefit, there's not an automatic guarantee, and you're definitely not going to accidentally fall into these rules, as you can see, of being able to deduct your rental expenses against your ordinary income. It's a very specific and intentional path that you have to build and plan for to make sure you're getting that benefit on the front end. And in some cases, what I do with my clients is we look to see, is it even worth it? Like, what are the expenses at the end of the day? If we spend all this time building out this specific plan to get the deductions today, is that even worth the effort for the deduction you're getting today when we're just going to lock out that deduction and be able to use it later, worst case scenario? So there's a balance, like all things with tax planning. Is the complexity worth the benefits you're going to get on the front end? That's what we work with our clients through. We come up with plans to make sure, is this a practical tax benefit that we want to go after? And if so, let's go after it, document it correctly to make sure that we can defend it if it's ever challenged by the IRS. But again, it's a matter of getting things documented on the front end, not assuming things are going to work one way just because you watched a TikTok video that told you that you're going to be able to deduct these things, and just doing it the right way so you can sleep better at night, save tax money. Reach out to us at McGowinTax.com, talk you through your specific situation, how to maximize your deductions, and make sure that you're filing your tax returns correctly.